What if the silver crash of 2025 to 2026 was not the collapse of a bubble, but a stress test of a system that quietly ran into physical limits? At first glance, the sell-off looked familiar. Prices surged, headlines multiplied, retail interest spiked, and then the market snapped lower. Commentators called it mania. Analysts blamed speculation. Leverage was cited, and once again, the story ended with the same comforting phrase: the market corrected. But that explanation only works if demand vanished. It didn't. Silver entered the mid-2000s with fundamentals unlike any period in modern history. This was not a decorative metal cycle or a monetary nostalgia trade. Silver had become a core industrial input for the energy transition itself. Solar panels required silver paste for conductive pathways. Every photovoltaic cell depended on it. As global solar capacity additions pushed toward record levels, hundreds of gigawatts per year, that demand became structural, not cyclical. Those panels would not be redesigned overnight. Substitution was limited. Efficiency gains reduced usage per panel, but total demand kept rising because deployment exploded. Electric vehicles added another layer of pressure. An EV used 2 to 3 times more silver than a combustion car, driven by power electronics, inverters, sensors, and battery management systems. Charging infrastructure consumed even more. Grid upgrades consumed more still. Silver flowed into places where reliability mattered more than cost. At the same time, supply barely moved. Global silver production had been stagnant for years. New discoveries were rare. Environmental permitting slowed development. Energy costs raised mining expenses. Many silver mines existed only as byproducts of lead, zinc, or copper operations, meaning production could not be ramped up simply because silver prices rose. This was not oil, it was not shale. Price signals did not summon new supply. Above-ground inventories thinned quietly, but the market was distracted. Financialization took over the narrative. Futures, ETFs, options, leverage. Exposure piled up faster than metal could be delivered. Margin became the mechanism, not supply. And as long as prices rose smoothly, confidence held. Then geopolitics entered the equation. Silver supply was not just limited, it was concentrated. A large share of refining capacity and downstream processing sat within a small number of countries. China played a central role in metals refining, electronics manufacturing, and solar panel supply chains. As tensions rose, Beijing began tightening export controls on strategic materials tied to national security and clean energy. In 2024 and 2025, China restricted exports of gallium, germanium, graphite, and other critical inputs. Silver itself was not formally banned. It didn't need to be. The message was unmistakable. Materials essential to future infrastructure would no longer move freely in times of stress. Western manufacturers noticed. Supply chains that looked efficient suddenly looked fragile. Long lead times replaced just-in-time delivery. Inventories became strategic again. Availability mattered more than price, but markets were still pricing leverage. That mismatch set the stage. When silver prices began to fall on January 30th, 2026, it wasn't because factories canceled orders or governments abandoned energy targets. It was because leverage had grown too large for the system to tolerate under tightening financial conditions. Futures breached maintenance margins. Funds were forced to liquidate. The selling fed on itself. Margin calls did what shortages could not. Prices fell sharply, not as a signal that silver had become unnecessary, but as a signal that the financial layer had overreached the physical one. The metal didn't lose relevance, paper exposure did. This is a pattern history has seen before. Strategic commodities don't collapse when demand disappears. They retrace when finance outruns reality. Oil in 2008, nickel in 2022, silver in 2026. The mechanism is always the same: leverage breaks first. Fundamentals assert themselves later, and that distinction matters, because after liquidation comes availability. Solar installations didn't stop. EV production didn't reverse. Grid expansion didn't pause. Governments didn't repeal decarbonization policies. The demand that mattered never left. It was simply priced through a forced unwind. Silver did not fail its role in the global economy. It exposed the limits of the system trading it. Markets called it a crash. Industries called it procurement stress. History tends to side with the latter. In every major resource cycle, the real signal isn't the price at the bottom of a margin call. It's the behavior of supply after confidence breaks. And in the case of silver, confidence never vanished where it counted, on factory floors and solar fields and inside power grids. Silver didn't remind the world how speculative it was. It reminded the world how necessary it had become.